Well, no. I wasn't sleeping. I was investing. And the more you're investing looks like you're sleeping, the better investor you're going to be. Let's look at 3 hard-learned lessons about what it takes to become a better investor today. So tap the like button and let's get started. Hi, I'm James Callahan and this is The Do-Over Show, and I have been my entire life a very impatient person. Yes, and that's usually something we grow out of. As we get older, as we mature, as our emotional maturity hopefully kicks in, we realize that we're able to be patient because we realize certain things take time. Except in this one area, with our money.
Billy, I need more money.
I'm just asking for a little bit of help. Just get me a little bit closer. I can't leave here with that.
What else can I help you with?
Even if you've learned patience in every other area of your life, if you have to do a do-over, you're still impatient. You're impatient with your money. I know, I feel it every day. We follow breaking news. We scroll through Twitter feeds looking for an edge. We watch endless hours of tutorials and YouTubers about finances and investments and breaking news. And yet we lose out to the pain of impatience. And the very thing that we need, we're like junkies. We just can't help ourselves when it comes to being impatient, when we try to use our money to make more money because we see other people doing it, successfully making millions, driving Lamborghinis, living the lifestyle of freedom and retiring at age 26. And we say, doggone it, I want to do that. How do I do that? And we miss out on the basics, the hard-learned lessons of what better investors know and what better investors do. So this is not financial advice. I'm not a licensed or registered or whatever it is financial advisor. This is for educational and entertainment purposes only. Disclaimer. But there are 3 things that I've learned that I want to share with you. 3 things about becoming a better investor that you can learn too. And here's lesson number 1, the edge that can help us become a better investor, and that is patience. Patience is learned through practice. It's not something we acquire overnight, reading a book, watching YouTube. Patience takes the development of habits, and habits to develop take time. So back in 2020, April of 2020, yes, that April of 2020, I began a lesson in patience. I opened up a Roth IRA and I contributed to it on a monthly basis, maxing out the contribution in order to develop a plan that I was going to practice patience. The grand total of my cash deposits from that starting point today equals $24,750. Now, the value of the account as of the end of the second quarter of this year is $26,109.26, or an increase of $1,359.26. That's not that great. But in the bear market that was 2022, when the S&P was down almost 20%, I feel like a survivor that ended up, well, stronger because I endured the bear market of last year. Now, that modest increase of just about 5% over several years, that's underperforming the market. Well, sort of, because last year I actually outperformed the market when it was down 20%. And that takes us to the second important hard-learned lesson about becoming a better investor. And that is knowing the difference between the types of investments that we can make and what the consequences of making that decision really are. That is, most of us chase returns and we want to see an immediate gratification, an upside. That's our impatience at work. And we feel things like FOMO, and that's what keeps us up at night, and that's what keeps us chasing after things that have already made their move, and we just want to jump in at the end, and we end up top ticking. That is when a stock runs up in price, and then we see it, we're always late to the party, and we say, ooh, I want to get in on that. And we do. And while we're buying in at the very top of the market, people who have already made their money are selling to us. Yep, we're called bag holders at that point, and you don't want to be a bag holder. Now, part of this second lesson is that learning that there's a difference between 2 basic categories of investments, of stocks. One is growth and the other is value. Growth is premised on the idea that the stock price will grow, and that's your benefit, that's your return, that's your incentive to own it, versus value, something that represents a value that actually is a discount to its trading value, and that you actually get paid a dividend to own it. The company pays you to own the stock and not sell it. Just hang on to it, please, so that the money is stable and therefore the stock ends up being more stable. Now, if you look at the past few months and you look at these phenomenal rises in certain stocks, just 7, we'll look at them in a moment, and you look at stocks like Nvidia or Meta, Facebook. Nvidia's jumped this year more than 192%, and Meta is up over 134%. And you look at that and you say, why couldn't I invest in those? Those phenomenal returns, and they are phenomenal, are once in a lifetime moves. And that's the story that leads. That's the story we see on the news every night. That's what fills YouTubers' videos, and so we think that must be normal. But the majority of that 38.8% run in the stock market this year is attributable to just 7, only 7 of the largest, best known, most famous stocks. And those 7 are Meta or Facebook, Apple, Amazon, Alphabet, also known as Google, Microsoft, Nvidia, and Tesla. They're called the Amazing 7 or the Magnificent 7, depending on which YouTuber you follow. And they account for the majority of the move in the markets, this uptick, this swing from a bear market to a bull market that we've experienced this year. And if you own any or all of those 7, then you're significantly outperforming the market if, and this is a big if you bought them at their lows. If you bought them at the end of last year, if you bought them when nobody else wanted to buy them, if you had the guts to buy things when they were actually on sale, and you chose the 7 out of the thousands of growth stock options, and if you had the money to put in because they were already significantly higher price, not value, but higher price than many other growth stocks, if you did all of that right, then congratulations. You're part of this 38.8% uptick this year. Now, the boring alternative to this growth stock story is value stocks. Value stocks that trade for actually less than their market value, and they return instead a dividend, usually quarterly, and they pay you to literally own the stock. So you make money while you sleep. You do nothing. You invest in them and you hold them. And yes, their stock prices can increase, and many in an up market, like, rising tide lifts all boats, many of even those value stocks will grow significantly. But in the market where those Magnificent 7 stocks excelled in their performance, growth stocks, which I own most predominantly in my investment account, in the Roth IRA investment account I'm talking about, most of those underperformed the market because people shifted their attention. They sold things that were underperforming and they bought things that were high performers. That is, they were trading, swinging those stocks. They weren't investing in them just to hold them for the long run. And in those markets, like the market we've just experienced, my value stocks didn't perform as well as my several growth stocks that I own. And that means that maybe I feel like I've missed out on something. If I take just a momentary snapshot, yes, I feel like I'm missing out. FOMO hits me. But if I take the right view, the long view of what an investment is, it's not buying and holding and holding and holding. It's buying, holding, and building, reinvesting through dividend reinvestment and through buying more each month on a regular schedule, dollar cost averaging, that I actually build positions in my value stocks. And this is a big part of that second hard-learned lesson about picking your risk factors and owning those decisions and staying with them and letting your decision work for you over the long run in investing. That is, you choose the amount of emotional risk that you are willing to take. Growth stocks fluctuate wildly, and they do track news cycles, and they are favorable one day and unfavorable the next day. Yes, they do make those big swings. Value stocks don't tend to have those big swings, and they follow a more general pattern of market cyclicality. Yes, cyclicality. That's a word you can learn by watching YouTube and CNBC. Now, my investments in the Roth IRA, as I said, are predominantly value stocks, and they return dividends that average about 4.9% annually. And I've held the same stocks and built positions in them for more than 3 years now. I own Apple. That's a growth stock. That's up almost 65% for me. Associated Bank, a value stock that's down more than 24% for me. B&G Foods, a consumer staples company that's down almost 40%. Duke Energy, which is down just 3.5%, and somehow being down just 3.5% makes me feel good. Iron Mountain, which is up almost 73%. Coca-Cola, which is down just 3%. Altria is barely up. A Realty Income Corp, a REIT, a real estate investment trust, is down 6%. Pfizer, that company, is up just over 1%. Simon Property Group, another REIT, which is up 23%. Now here's an ETF I own, Ph.D, or the S&P High Dividend Low Volatility ETF, and that's up just 2%. Now here's the one that really hurts, Presidio Property Trust, another REIT. It's down 75%. They cut their dividend drastically, and that's what will happen to a value stock when they cut their dividend because their sector or their business model is underperforming, especially a REIT, which they're required by law to distribute a certain amount of money. They're also required to cut their dividend drastically when they're underperforming. Now, they're in the model home leasing business, and if you didn't know, that's not a great sector. And then I own Walgreens, or Walgreens Boots Alliance, and they're down almost 32%. Come on, Ross Brewer, get it together. So what do I notice? Well, Apple and Iron Mountain are my top performers, and just one of them, Apple, is part of the Magnificent Seven. But this account, this Roth IRA, is an exercise in patience. It's a snapshot of one quarter, not what I look at to judge if this is working. I hold these investments, I can sleep at night, and I can build positions in them. They've been around, they will be around, and they pay me to own them. That is, I'm following a steady progression of the bottom left to the upper right, and that's the movement that I get through my cash investments monthly, the slight uptick in stock prices, and the dividends that they pay me that are reinvested to build those positions. Now, I have other accounts for other types of investing. I have accounts for trading options, for day trading, for swing trading. I have several accounts for crypto. Yes, I have accounts that are spread elsewhere, but this gets us to the third lesson in better investing, this hard-learned lessons, and that is keep the damn accounts separate. Learning this practice of living with your choices, living with the amount of risk tolerance that you're willing to take and still sleep at night, and also learning to keep things clear and clean and separate so that you don't confuse one risk tolerance model like an investment, long-term investment in a Roth IRA where you're building positions versus day trading or swing trading or getting involved in wild swings in the crypto market that you would hold in another account. Don't confuse them. Don't mix. Don't compare apples and oranges. Learn to keep them separate so that you are able to have different views of different types of accounts if you have different types of accounts. Now, for most people who don't spend their time investing and looking at the markets every day, you just have one type of account. So don't treat it like a day trading or a swing trading or a crypto account. Treat it like something that you want to, like buying a chair, buying a house. Warren Buffett uses this analogy that the utility of a house is that you get to live in it. So when you buy a house and the price of your house drops the next day, you don't sell it and abandon it. You hold it and you invest in it. You keep the value of the house increasing by making improvements in the house. The same way you build positions, long-term positions, because you're building a new hard-learned lesson of patience. You buy a house to live in the house. You invest and build a position in a strong dividend-paying value stock in order that it may pay you to own it. These are life-changing but plain and ordinary things that when we learn to practice them and we apply ourselves daily, will turn our investing more into something that looks like we're sleeping, and we'll be better off for it. And thanks for being part of the Do-Over Show. Please, could you tap the like button, because that's an investment that pays and it benefits me. And while you're down there, how about you subscribe and ring the notification bell so you don't miss the next episode. I'm so glad you found me and I found you. Thanks.